Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vale stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vale is engaged in metals and mining and is one of the largest logistics operators in Brazil. The company is headquartered in Brazil and was founded in 1942. It went public in 2000 and currently trades on the Nasdaq. It is the largest producer of iron ore and nickel in the world. Vale also produces manganese, ferroalloys, copper, bauxite, potash, kaolin, and cobalt. It operates 9 hydroelectricity plants and a large network of railroads, ships, and ports used to transport its products. Let's get started with the model. This is a large cap company, 98 billion market cap. They're trading at $19 a share, and they have 5.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have pretty consistent free cash flow from 1.6 billion to 1.8 billion. Net income is the profit and loss on the income statement. That's a revenue minus expenses. That was negative in 2019, positive in the other years. Revenue is the sales for the company, and that grows a little each year from 6.1 billion to 7.2 billion. This is the company's income statement. All of their financials are in Brazilian reais. I converted the numbers to US dollars on my Excel spreadsheet. The top number is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference is the gross profit. They had their highest gross profit in 2020. Below that is operating expenses. Example is depreciation. Then below that is operating income, and that was also the largest in 2020. They paid 2.4 billion reais of interest on their debt. That's a little less than 2019, but much higher than 2018. Then there's other income and expenses, which are usually impairments or write-offs. They had a big negative in 2020, even bigger negative in 2019. And the bottom line of the income statement is their net income. The reason they had negative net income was because of this large asset impairment. I would focus on operating income when I look at the income statement. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. In 2017, they issued 2 billion of debt and paid down 9 billion, so they decreased their debt load 7 billion in 2017. They decreased it 6.5 billion in 2018. A decrease of 2.5 billion in 2019, but it looks like they increased their debt load 500 million in 2020. They also bought back 1 billion of capital stock in 2018. When a company buys back capital stock, it decreases the shares outstanding, making your shares more valuable. Let's look at the capital structure. 6.4 billion of equity, 3.6 billion of debt. They're 64% equity, 36% debt. Their net debt is 1 billion, and their WACC is 5.9%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 73 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $66 billion. We divide that by 5.1 billion shares, and we get a calculated stock price of $13. They're trading at $19, so they're trading at a 49% premium. It's a sell according to the model. Simply Wall Street is a little higher than me. They're at 14 a share. They're also saying the stock is overvalued. 8 analysts priced this stock in the past 3 months. The average price target was $24. The low was 18, the high was 26. The only thing that dictates the stock price is supply and demand of the market. If more people want to buy a stock, it pushes the price higher. If more people sell a stock, it pushes the price lower until equilibrium is met. A company can have amazing financials and its stock price goes down. A company can have terrible financials and the stock price goes up. Market sentiment plays a huge role in the stock market. This is a stock price the last 5 years, so it looks like it's trading at its all-time high. It nearly doubled in the past 5 years. And this company pays a 6.39% dividend. They pay a semi-annual dividend payment. They have a pretty low beta, 0.65. Their stock has gone up 140% in the past 52 weeks, while the S&P 500 went up 48%. The 52-week low was 736, the high was 20. And the stock is trading above its 50-day and 200-day moving average. This is a really liquid stock. About 25 million shares are traded each day. And of the 5.1 billion shares outstanding, 4.5 billion are on float, 23% are held by institutions, and 1.17% of the shares are shorted. If you include dividends in the past year, this stock has gone up 167%, while its industry went up 105% and the market 61%. In the past 5 years, this stock has done really well, up 333%, its industry 121%, and the market 121%. Analysts are forecasting their earnings to grow 7%, its industry to grow 14%, and the market 18%. Analysts are forecasting their revenue to grow only 1%, its industry 6%, and the market 10%. In the past 5 years, their earnings grew 37%, while its industry grew 20% and the market grew 12%. If you invested $10,000 into this company 10 years ago, you would have been down to $1,000 at one point, but if you would have held out, you'd be at $8,900 today. That's a 1% annual loss. The biggest shareholder is Capital Research at 15%, then Banco do Brasil at 10%, BlackRock, and then 2 other companies at about 6%. Let's look at the financial ratios. The average PE is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 112, so investors are paying $112 for $1 of earnings, much worse than the median average. Price to sales is 13.6, also worse than the median average. Price to book is 15.3, which is also worse than the median average. Their return on invested capital is a solid 36%. Their interest coverage ratio is 7.5, ROE of 14%, which is pretty good. Current ratio of 1.7, and their current assets are $14 billion of cash, $5.7 billion of receivables, and $4 billion of inventory. These numbers are in reais. This current asset number is in US dollars. They do seem to be undercapitalized. They had $1.8 billion of free cash flow, $1.8 billion working capital, but they pay over $6 billion of dividends, so they're short $2.7 billion, so they may need more debt or equity to run their business over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos on American Battery, BHP Group, MP Metals, and Tech, all in the same industry as Vale. And if Vale has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They have a bad PE because of the high asset impairment. They're doing a little better in price to sales than the average. They're worse in price to book. Their current ratio is fine, even though it's worse than average. Only them and BHP have a positive ROE, so they're in good shape there. They're a little lower in debt than average. And they're the second biggest company on this list, and they pay the highest dividend. So to summarize, I have them trading at a 49% premium. So this looks like an overvalued stock, but this is a pretty solid company that's generating significant revenue and free cash flow. They are also in an industry that's relied upon by every country around the world. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.